Welcome to Market Matters, our market series here on JP Morgan's Making Sense podcast. Hi, I'm John Schlegel, Head of Global Positioning Intelligence here at JP Morgan. Today, I'm excited to be joined by my teammates Andrew Tyler and Ellen Wang to talk about U.S. equities following the recent sell-off and rotation, as well as the start of earnings season. Drew is head of the U.S. Market Intelligence team, and Ellen is a member of his team who does a lot of analysis around earnings season. And I'm looking forward to hearing their most recent views on markets. Drew, Ellen, thank you so much for joining me on this podcast.
It's great to be here, John. Thanks for having us.
Thank you for having us, John.
In the past few weeks, the S&P 500 has seen just under a 5% peak-to-trough decline from all-time highs, while the Russell 2000 has rallied about 12%, making it one of the biggest periods of outperformance in history. Also, we saw tech, including both the so-called Magnificent Seven and semiconductors more generally, get sold too. So, Drew, what do you think drove this from a fundamental macro or micro perspective?
It's a great question, John. So let me start with the macro perspective. There, the catalyst was the July 11th CPI release that showed a negative month-over-month number, which really cemented the view that the Fed would cut no later than September. Separately, the stronger-than-expected retail sales print on July 16th pushed the market back to the Goldilocks narrative of a U.S. economy that experiences growth without any subsequent inflationary impulse. And shifting gears and thinking about this from the micro perspective, people are using earnings releases as a proxy, and there the outcomes are very mixed, as Ellen will kind of go into a bit more details on later. But generally speaking, banks and credit cards point to a still healthy consumer as well as airline data. But we were seeing weakness in retail and restaurants that points to a consumer that is getting pickier with its choices and in some cases delaying spending decisions.
That's really interesting. And from a positioning perspective, we are seeing some of the themes you mentioned play out a bit, with some flows into banks, but bearishness in particular in retail and restaurants. So looking more broadly, how are you thinking about this latest sell-off relative to either what we saw in April of this year or the summer of last year?
So in both cases, of summer of 2023 and April of this year, what we saw was bond yields surging in response to hotter than expected inflation data. In summer 2023, the bond market was reflecting a view that the hiking cycle may be extended beyond the July 26th Federal Reserve meeting, even though that did end up being the last hike of the cycle. In April this year, we had a market that was pricing in 3 to 4 rate cuts, and the hotter inflation data shifted that view to 1 to 2 rate cuts occurring this year. This current pullback is more of a rotation, and with tech selling off that is dragging both the S&P and NASDAQ lower, the drivers have been a combination of the potential for rate cuts being less than expected, an exhaustion of the AI trade, and increased expectations for improved earnings growth for the S&P 493, or called the S&P 500 minus the Magnificent Seven. So having said that, it gives me a question for you, John. What positioning themes are similar or different now versus April or summer of last year?
Thanks, Drew. Coming into both prior sell-offs and the current one, U.S. positioning levels were arguably at cycle highs. The other thing that was elevated was the focus on tech and semis, and positioning in that area was also very high recently as it was into those prior peaks. So far, if I think about what's happened in terms of the sell-off, we have seen position come off, but it remains around the 80th percentile versus the 10-year history. And if I look back to April of this year or August, October of last year, we ended up getting to more neutral or even more bearish levels. So from that angle, there hasn't been as much de-risking yet. One of the things we saw both in April as well as last August, October is hedge funds regrossing and in particular pressing shorts. Given the rotation we've seen recently, there hasn't been much of this yet, and that's one thing I'll be watching for. That said, if the sell-off continues to be mostly tech-related while the macro data remains Goldilocks, it's not clear how much reshorting or regrossing we'll see in the near term because hedge fund shorts have generally worked better when rates are rising and lower quality stocks are selling off. So as we shift to more forward-looking events, let's discuss earnings season. Ellen, can you give us an overview of what was expected and how we have started with over a third of the S&P 500 having reported so far?
Yeah, thank you for having me, John. So far, about 40% of the S&P 500 have reported, and the aggregated earnings and revenue surprises about 4.5% and 1% respectively. As such, if we assume the market consensus for the rest of the company's host, that will give us a 10% and 5% year-over-year growth in earnings and revenues respectively. If 10% is the actual growth rate for the quarter, it will mark the highest year-over-year earnings growth rate since Q4 2021. On sector basis, tech and financials are the leading earnings growth. Interestingly, comparing to previous seasons, markets has been rewarding less on positive surprise and punishing more on negative surprise, partially driven by the fact that equities reached their all-time highs into the earnings season. So the issue is the bar has been high. In terms of macro read-through from the earnings call so far, overall, we are seeing more cautious but not stressed consumers. Two trends we have been seeing. First, companies are seeing further divergent behaviors across different income cohorts. Banks, airlines, and consumer products pointed that low-income consumers are substituting for cheaper products. Second, a number of the companies highlighted higher price competition and cost. They pointed that consumers have become more price sensitive, especially on grocery bills. So to sum it up, growth as a whole is looking good and above trend, but the price action bar has been high going into results. And for consumers, there do appears to be a few pockets of weakness.
That's interesting, Ellen. So it seems a good start so far, which generally is in line with relatively robust economic data that we've seen recently. For example, the Q2 GDP report coming in above expectations. And if you think aside from earnings, what other macro events are you focused on?
Yep. In near term, remarks from the Fed this Wednesday, particularly on the path to rate cuts in Q4. On macro data, I would say ISM this week and next, as well as CPI on August 14th and retail sales on August 15th will be critical to reassess the Goldilocks narrative. Additionally, U.S. election headlines in the next few months will be certainly impactful for stocks in near term as well.
Those all make a lot of sense and perhaps suggests that I might need to keep paying attention to markets in August, even while I'm sure many others, are planning to take some time off. But in particular, your point on the Fed and various macro and political catalysts make me think right back to rates and how important they might continue to be for fixed income markets as well as equities. One thing that's been interesting to me recently is that CTAs are now much more neutral in 2-year and 10-year rates in the US after having been relatively short back in April. They're not long yet, and we think there's room for hedge funds more broadly to potentially cover shorts further, but it does suggest a more balanced view, which could have implications for equity markets in aggregate and any further rotation. Okay, so Drew, putting it all together, are you still bullish, and how are you thinking about monetizing your view?
So I am still bullish, though the conviction levels are probably a little bit lower now than they have been over the past, let's call it year and a half. But I still like the barbell trade. And so the barbell trade, as a reminder, is some tech stocks and some cyclical sectors, including parts of financials and industrials. And while I understand the tech trade feels a little bit challenged, the earnings delivery remains robust, despite some stocks selling off because their earnings did not beat expectations by a large enough magnitude. So when I'm sitting here thinking, too, about tying this back to some of the consumer trends that Ellen mentioned, am I really worried? The answer to that question is not yet, because we're still seeing the aggregate consumer, so across high-end, medium, and low-income consumers, is still holding up pretty well, despite their challenges that the low-income consumer still faces.
Thanks, Drew. Those are fair points. I'd say the cyclical part of the barbell is where we've seen a bit more recent positive reversal after both financials and industrials had seen strong selling into mid-June and early July, respectively. Tech will be a very interesting one to watch from a positioning perspective, as we're seeing some risk reductions recently, but I've seen multiple dips of this sort bought back quickly when the story held up. So what about you, Ellen? Any favorite trades?
Absolutely. The resilient macro fundamentals and healthy consumer read-through from earnings so far, particularly on the mid to higher income cohort, both supports retailers and credit card companies. To think about the hedge on this trade, maybe consider staples, given that they are more exposed to low-end consumers.
That's great. Thanks, Ellen. So to recap briefly what we discussed, it seems the economic backdrop is generally holding up, but there are some potholes that we're seeing in the consumer space, which makes things a little bit trickier. Drew, as you mentioned, you're still positive on your barbell trade, although conviction's a little bit lower than it was in the past. And earnings season is generally holding up well. And I'd say from the positioning angle, we've definitely seen some risk come off, but not a whole lot yet. And so compared to prior sell-offs, it's still not quite clear whether or not there's been enough done or if we could see a little bit more to go from here. Thank you so much, Ellen and Drew.
Our pleasure. Happy to be here.
Thank you. Our pleasure.
Thank you also to our listeners for tuning into this biweekly podcast series from our group. If you have feedback or if you'd like to get in touch, please go to our website, jpmorgan.com/market-data-intelligence, where you can send us a message via the Contact Us form. And with that, we'll close. Thank you.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan. They are not the product of JP Morgan's research department and do not constitute a recommendation, advice, or an offer or a solicitation to buy or sell any security or financial instrument. This podcast is intended for institutional and professional investors only and is not intended for retail investor use. It is provided for information purposes only. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures/sales and trading disclaimer. For the avoidance of doubt, opinions expressed by any external speakers are the personal views of those speakers and do not represent the views of JP Morgan.